Good afternoon, ladies and gentlemen. I don't know what to start with. The room is half empty or half full, but let's start on an optimistic note. It's half full. And insurance companies don't pay claims on time. That's what they're notorious about. But we will start our proceedings on time. And welcome to this session 4C, which is one of the parallel sessions of this Asia Finance Forum. And this session is on microinsurance, expanding through education, technology, and stakeholder cooperation. So we'll be discussing three elements, which includes education, technology, and stakeholder cooperation. We have a very distinguished set of panelists amongst us. Let me start on my extreme left with Kumar Sheller, who has been a pioneer in terms of running a cooperative-based health insurance scheme in India, empowering women and slum dwellers to purchase health insurance. And something very unique, not only in terms of providing insurance for the poor and meeting development objectives, but also in terms of how he is using technology to meet some of his development objectives. Next to Kumar is Brandon Matthews. He has been instrumental in starting microinsurance divisions in two multinationals. One is AIG and the other is Zurich. I don't think AIG and Zurich need any mention what they do, but Brandon then, of course, branched out from the real life of commercial insurance and started his own startup where he's using technology in expanding inclusive insurance in many countries in Africa, Asia, and Latin America. But in Asia, he's looking at Myanmar, Indonesia, Malaysia, and Nepal. So that is it. And then the lady on my left, last but not the least, she is a rocket scientist. She's a new kid in the block, I would say, but a very determined entrant in this block of inclusive insurance. And she's the one who is introducing some of the latest financial technology, which includes blockchain. And you'll hear more from her in terms of how she thinks. And we are trying to solve problems for different income segments and also different age segments. And she's a millennial, definitely, or will look very closely at the millennial consumer. So we have a range of experts. And just to give you a very brief introduction about this topic, microinsurance is nothing new in that sense. I think insurance started with microinsurance. And today when we are talking of insurance for the poor, it is really something where we need to look back to look at it. So when insurance started, it is the poor people who had their own risk-sharing arrangements in place, and they expanded over a period of time. They did not have the management skills to manage those types of funds. There were failures, and then regulators and the government stepped in. And with repeated failures, one layer of regulation and laws, they kept being built upon one after the other. And today we have a very complex insurance sector operation in different countries around the world. But insurance started with microinsurance, be it providing fire insurance for shops in UK or health insurance in Asia, and also for insurance against ships and boats in China. In the modern sense, microinsurance is a term which is about 2 decades old. Some of the pioneers in microinsurance has been Philippines, of course, India, Mexico, Bangladesh a little bit, Pakistan. They were the forerunners in terms of coming out with regulations on enabling environment for microinsurance. And the good thing what happened in this process was there were some new distribution channels, what we then termed as alternate distribution channels, which were identified. These are some things which our panelists will explain a little bit more. And certain new products were also developed, like credit life insurance, health insurance, and weather index insurance. In fact, we have one more person here whom I know well, who worked with me. I was in the regulator's office. He was working in an insurance company in starting one of the first weather-based index pilots, which scaled up into one of the largest successful experiments in the world. And it was replicated not only in India but in many other countries. Now, there was something interesting. Those who were present yesterday for our pre-sessions, financial inclusion is going through a paradigm shift. We have been talking about access to credit, but what we heard yesterday and something which also resonates with my thinking is we are now moving to the new paradigm of financial security. And when we look at financial security for the masses, we need to look at insurance and pensions as also one of the solutions. And financial security is a much broader term. It's not only insurance and pensions, but it is also protection for consumers, even for bank, to ensure that their bank deposits are there to be withdrawn when they need. The banks should not fail and things like that. So protecting institutions, protecting customers is also very, very important, and the role of a regulator assumes significance. So in this context, we are not only going through a paradigm shift from financial inclusion to financial security, but we are also looking at creating new institutions and models which refine the value proposition for people to buy protection. So it's not protection for the whole year that you buy. You can buy protection, say, while you are traveling, like you buy a travel insurance when you board the aircraft, or you buy an insurance when you are undertaking a train journey and things like that for very specific periods of time. And those concepts also have been used in crop insurance, livestock insurance, and other cases. So we need to redefine the value proposition, and in doing so, we need to see how technology can enable us by designing new products and using more innovative distribution channels, not only to sell insurance, but also to service insurance. Something which we don't discuss in panels. We don't talk about servicing. Once the product is sold, how will it be serviced? That is something I have not heard in the past few days. And that is something we need to be very, very conscious about. And then we have to look at issues regarding what I say the 5 A's, availability, adequacy of premium, adequacy of service, accessibility, affordability, and ultimately the appropriateness of the product itself. So those are the 5 elements we need to be always aware of, be it an insurance product or any other product. And there are a lot of applications which are unfolding. The low-income population's only problem with that is what we heard today morning is the issue of trust. And trust, there is a serious trust deficit. People don't buy insurance for a reason, not that they are ignorant of the benefits of insurance, but there is a serious trust deficit. This is something which needs to be taken care of. And also in addition to that, we have to see at the other 5 A's. So without further ado, let me start with the Q&A in terms of asking the panelists. I'll be asking questions to each panelist and they will be responding in about 5 minutes time. After this 15-minute round, I will open for the Q&A, the top 3 questions with votes will be responded by the participants in the next 5 minutes, and then we will have a second round of discussions, and then we'll give another opportunity to the audience to ask questions. So we want to ensure that it is very interactive, and your participation is very important in ensuring that this session is successful and it meets your objectives also, because you're also spending your precious time. So let me start with Kumar, who is on my extreme left. And Kumar, as I just mentioned, microinsurance is not new, and it started with the poor people at the forefront, and now we see a behemoth insurance industry which really ignores the population, which gave birth to this idea and concept of insurance. In your experience, what are the gaps which have not been addressed in a country, and I'm referring to India now, where the modern concept of microinsurance took birth in 2000 when the sector was opened up? That is one. And I would also like to have your views in terms of what is the problem in scaling up microinsurance, and why are regulators always circumspect with respect to innovation?
Thank you, Arup. Hi, everyone. 3 points to that. I think it's a humongous question and cannot be answered in 5 minutes, but still I'll take a call from where we come from. I think microinsurance does not have a mass movement behind it. If you look at Indian scenario, whether it is microfinance, cooperatives, they have all had a mass movement behind them. Microinsurance was, in the way I understand, the way we understand, it was a very top-down approach where you said this is what microinsurance would look like. So that may be one of the reasons why it does not find so much of resonance with the people. Trust is a factor, but I also think that microinsurance failed to look at existing risk management tools that were available within the society. So people were already doing a lot of risk pooling, people were already doing a lot of risk management together. And somehow buying it from an insurance company became a foreign idea. At least what we saw in the slums and villages of India, we have seen that people don't trust somebody from outside, but they were very happy pooling risks within themselves. So I think that's one thing. The second part about why microinsurance has not been scaled and what the regulators have been looking at it, I think when you say something like a microinsurance thing, you are targeting certain people, that is good. But what it also does is it makes it sound a little exclusive. In our understanding, if you would make it affordable insurance where anybody could have bought it, you would have seen a different uptake of the product. So the very idea of calling health as micro, as in it does a lot of disservice in my understanding. If somebody's health cannot be micro and my health will be macro. So I find that extremely difficult to understand. So I think if you want a mass adoption, you have to come out with a mass product and don't label it as micro. When Uber decided to become a mass company from only serving cars to the rich, it did not say itself we are doing micro carpooling. It did not say that. So I think there has been a lot of disservice in the term itself. That's one. And I think scaling up. See, we live in an age where you have the Chinese do a mutual in 6 months, 50 million people. I think scale has to be also understood in terms of impact, not just numbers. And where I come from, it took me 14 years to work across 9 communities, trying to explain people what insurance really can do. So I think we are very impatient people when it comes to insurance. Insurance needs more patience, I think, and also insurance should look at risk reduction as a feature, not just risk management. So if you really want to work for the what we call poor or low income, you have to really look at where their priorities are. Their priorities are not in risk reduction. Their priorities are risk management. Their priorities are in risk reduction. They always look at risk reducing the risk, but insurance always looks at managing risks. I think, yeah, that would be my.
Thank you. I think just to, I don't need to qualify what you said, just to add one more in terms of insurance. In addition to risk reduction, I think another element is the access to credit. Of course, you were taking the health example, but what people want is access to credit and not access to insurance or access to finance. Let's move to the next panelist, Brandon Matthews, who has worked with 2 multinationals and now has become an entrepreneur. And well, I knew him from the days when I was doing regulatory job. And Brandon, what is the real challenge you have seen in terms of expanding microinsurance in different countries? Is it regulations, or is it government policy, or both? And then the second is, does microinsurance make business sense?
I'll start with the second. Yes, it definitely makes business sense. I mean, insurance globally, $5 trillion industry. So if it were a country, its GDP would be the 3rd after China and the United States. So massive, massive industry, and it's run by actuarial, the science of actuaries. And so it definitely can make money. It may be the time period in which one makes money, ups and downs and whatnot. If you read an insurer's quarterly reports, you'll find that even giant insurers sometimes get things wrong. But over the long term, there's no question that this is a profitable business that really works. It's also a hugely impactful business, not only for the ex post benefit when somebody has a claim, a health event, a fire in a market stall or what have you. I mean, that seems kind of obvious that that's a good benefit, but it's the ex ante. It's the ability for the parents to keep their kids in school, or the ability for the merchant to carry a little bit more inventory. That's a huge part of insurance. And then, of course, the fact that people who are sick can afford the hospital means that you get hospitals where people are sick. And so I'm a big advocate. I think it's almost a magical product in all of the things that it can do. But the problems, as have already been mentioned, trust is definitely one. And I think it's because it's a complicated product. We're talking about its savings for events that nobody can really save for. I cannot save adequately for the worst case scenarios, and so it's there. It's credit offered by an insurer. They are lending you their balance sheet, and so typically they're looking at you in a microscope thinking, are you a worthy borrower of my balance sheet? Because I'm going to loan you a piece of my balance sheet. I'm taking your risk from you and putting it on my balance sheet. And in a way, it has that same effect of credit. Those are the 2 other big pieces of financial services, and so it's quite complicated. And so the regulators have to face what is effectively, it's not even one complicated industry. Life and general insurance are different in Brazil. Life, general, and health are all different, even with different accounting concepts. And so they're facing a quite complex industry that is very large and has a lot of money to do different things. And they're typically underfunded. Say in the markets where we work, there's almost no insurance. And so the regulator, of course, is then quite has not so much money or staff to do their own work. And I find that it can be hard for a regulator to hear what policymakers actually want from them, whether they want to control the industry or whether they want to grow the industry. And without growth, nothing's going to happen. People won't get insured. But giving a soft benefit to insurers doesn't feel like it's going to be politically viable. And I think that you asked about regulators and policymakers. I think that policymakers can already do speak clearly, but I think that regulators tend to maybe hear maybe there's an undercurrent or something, some hidden message here, and that regulators need to hear that really what is needed, especially in countries that have lower than 2%, say, insurance penetration, is growth. And that it's going to be a market economy, it's going to be competition that's actually going to create a difference. But those are just some of the challenges of getting it in for sure now.
So some things are lost in translation when regulators try to implement policy.
Yes.
So let's move to the third panelist, another perspective. Maria, what motivated you to enter this fascinating insurance space full of challenges? And what is the problem you want to solve using technology in insurance?
Well, thank you all for joining this panel, first thing. And what motivated me was, I can say, it was my father. I grew up in Spain in a lemon farm, and we suffered some hails. And my father say, I'm saving because I'm not taking insurance, because there are so many layers of brokers that at the end what you really contribute to is so little that I do much better self-protecting myself. At that moment I didn't understand a single thing, so I left home, I went to study, I started in the space industry. I've been there 15 years and I love it. But also in 2015 was when blockchain became a bit more mainstream, and I'm passionate with technology. So I started learning blockchain, understanding. I created a company in Luxembourg to provide services and consultancy to the industries that are in Luxembourg, so banking and insurance. And then I learned all the challenges that insurance companies have to provide microinsurance, and especially in agriculture. So at some point the loop closed and I changed my gears, and I say I want to try to use technology to break or to try to break some of these barriers. And I started with this project, and I was lucky enough to bring on board experts from this industry, because I was coming from the technology, so I needed people from this segment. And it was the first time I learned that actuaries exist. So it was a good experience for me, and I can say that the space is very exciting industry, but touching people in the field and helping them is more. So the problems we are trying to overcome, I think it's a bit what Arup mentioned of the 5 A's. And despite that microinsurance is not a new thing, nobody, and there are new and new initiatives, none of them has been fully successful providing this. So how technology can change not only the profitability for the companies, but the experience, the value proposition for the farmers. So today the solutions are not sustainable, are really cumbersome to use. They will pay very late, and that's why there is no trust. Because a person can give you the trust once, but not twice. So, for example, what we are doing in Ibiza is not really an insurance. We enable mutuals. So I also got really passionate with the model that Kumar is working in, the mutuality, so the risk sharing instead of transferring risks. So what we do is we use a blockchain technology infrastructure to scale up mutualities, to scale up mutuals, to make automatic the back office of traditional insurance, and to bring trust by one single ledger and the properties of immutability of blockchain. And we use space, Earth observation data to build the risk models and to do automated loss assessment. So for example, how does impact the farmers? So we don't wait for claims. So every month we do an assessment and based on an index, and if there is a loss that it can be observed from space, we do a partial payment, meaning that the second month of the season, the farmer, for any reason, the vegetation is not growing, and then they will receive a partial compensation, and then they can do a second sowing